Good afternoon, everyone. My name is Vida Berhusier. I'm a Toronto Real Estate Board member and a proud board member of PICRA associations. I would like to thank you all for joining us today. We are here with another one of our valued guest speakers, Mr. Adam Sirota. Adam is a tax litigator who has litigated disputes at all levels of tax dispute resolution. Adam's practice focuses on HST in a court proceeding as an expert on HST in real estate. Welcome, Adam. I'd like to ask all our viewers to please type down your questions in the live chat, and at the end of Adam's presentation, I would read them to him and he will answer them all. Thank you so much, Adam, for joining us. Welcome. The floor is yours.
Thank you. So I'm going to just start our PowerPoint presentation. Okay. So our focus today is going to be on HST on new residential real estate. And we start with a famous quote. I love this quote. It's the hardest thing to understand in the world is the income tax. And that's by Albert Einstein. It just shows the complexity and that it's okay to ask questions in the area of tax. Not even Albert Einstein was a tax expert. So we're going to talk again about HST on new residential construction primarily. When new residential real estate is built, HST must always be considered, regardless if it is an entire condominium building or just one freehold home. And the analysis and the discussion on HST starts with the definition of builder in the Excise Tax Act. So the definition of builder is extremely long and it's extremely complex. We're going to parse through this a little bit. This is found the ETA. I'll refer to it as the ETA. It's the Excise Tax Act. The definition of builder focus, we're going to look at A primarily, sub little a. It's at a time when a person has an interest in real property on which the complex is situated, carries on or engages another person to carry on or for the person. And we're going to go to three little I. In any other case, the construction or substantial renovation of the complex. I underline substantial renovation. You can be rest assured that's not in the act. And the definition continues for the primary purpose of making supplies of the complex. And we're going to talk about that. You see here it says, but does not include. That is the exemption out of HST for who is not a builder. And you got to understand builder, and whenever we talk in the legislation about defined terms, builder is not what you and I think is a builder. It's not. A builder has a specific definition, and people say, "Oh, I'm not Mattamy Homes" or "I'm not Minto." That doesn't mean you're not a builder under the Excise Tax Act. Okay, so this definition is extremely complex and extremely confusing. I've personally been in court with judges who were totally lost on that definition. But what we need to do is we need to assume that HST applies on a new construction residential property every time, especially if it's for the purpose of reselling the property. If you're building with a profit motive, you're going to be subject to HST. There's no way out of it. If you build a commercial property and you lease it out to a commercial tenant or you lease it out to a residential tenant, we're going to talk more a little bit about that later. You have to assume HST is applicable. Now, when a property is what's called substantially renovated, that's what I described and I underlined earlier in the definition, and it is subsequently sold, HST will apply. And again, the proverbial rule of thumb in HST and new residential real estate is if you can't get out of HST, assume HST applies. So we always look for exemptions rather than the opposite of trying to get in. It's a better way and a safer way to look at HST on residential construction. So we're going to talk briefly about substantial renovation. And once again, we have a very convoluted and far too complex definition than necessary. This is found in section 123(1) of the Excise Tax Act. You'll note in the middle of the paragraph here, it says a few things are excluded. So if you look at the 4th line from the bottom on the far right, it says, other than the foundation, external walls, interior supporting walls, floors, roofs, staircases, and then it goes on to the common areas. And when you're dealing with, let's say, a home that's been what you and I would call gutted, okay, you got to determine if the house wasn't demolished and it's just gutted, is it subject to HST if it's being sold? And if you look at this definition, number one, it's obviously poorly drafted in my view. That's my personal opinion, but it is the definition we have to deal with. With these exclusions, you ask yourself a little bit, what else is left? If we're not factoring into this definition the foundation, the external walls, the supporting walls, the floors, the roofs, and the staircases, there's not really much left on the inside. And CRA has actually a pretty good technical bulletin here. I've put it down in the slide for anyone who wishes to reference it. CRA's position is generally all or substantially all is interpreted as meaning 90% or more. To meet this requirement, at least 90% of the building that existed before the renovations began must be renovated to some minimum degree. The determination applies to the interior area of the building. So as you can see, and judges have already told CRA, this 90% figure is totally made up. They just made it up. They pulled it out of thin air. There are some court cases who say, yeah, that's probably right. But nobody really knows because the definition, clearly it doesn't say 90% anywhere. How CRA litigates these matters is what they do is they do one of two things in the normal course. One, first way they look at this is they'll look at the whole interior. They'll get a list of everything that's been renovated and they'll guess. That's the truth. They'll just guess and they'll think, does this look like a substantially renovated property? The reason why CRA put a 90% number there on the substantial renovation is because they don't want their auditors just to guess and kind of figure it out. Auditors at CRA are, for lack of a better term, really robotic in their methodology. So CRA has given them a literal checklist to figure out if something is 90%. And most of the auditors will go room by room and count the walls. So one thing you'll note is, yes, interior supporting walls are excluded in the definition, but CRA will ask, did you redo the drywall on that wall? What happened in this bathroom? What happened to the kitchen? I think it's common sense if someone has crossed the 90% threshold in a renovation. If you've fully gutted a house right down to the studs, I mean, you're going to know just by walking in. Now, one thing that you want to note is substantial renovation implies that there's an existing property. The courts have said that an addition is not necessarily a renovation. And I believe it was Justice Visser, I believe it was, in a decision called McLean, brilliantly noted that you can't renovate something that doesn't already exist. So the courts noted that an addition doesn't necessarily mean renovation. It's quite clever. There are other cases that say if you put additions on the home and it's effectively a new house, you could fall into HST. So one thing that you want to do is when you're selling a newly renovated home is to really be careful about HST. If you look at the home and on a common sense perspective, you say, look, this house was gutted. I mean, the before and after pictures don't lie. This is a brand new house effectively. It's going to raise some suspicion with CRA and there could be an HST problem there. HST, actually, we've had some experience with HST on condos. So HST department has said and admitted that it's because in a condo, to renovate a condominium, you can't really get in the walls and CRA mostly wants to see what's happened in the walls. So I think we just lost the share screen, but the PowerPoint. But sorry, just go back one slide. So CRA has said it is extremely difficult, if not impossible, in a lot of circumstances, to substantially renovate a condominium. Obviously, that's a case-by-case issue, and it needs to be determined in each case, like I said. Now, if a house is demolished, forget it, you're into substantial renovation. Once a house is fully demolished, you've got an HST issue when you rebuild the house, and it's substantially gets to that 90% point. There's no, we see this all the time. There's an old house on the property, it gets demolished, and then a new house is being rebuilt. Once that house gets to a sort of livable state, no doubt about it, HST is kicking in. You're not going to get out of the substantially renovated definition. So there's a lot of CRA audit activity in this area. CRA is aggressively auditing new residential, especially freehold homes. In the past, they were, in about 2016, 2017, they were aggressively going after assignments. And we're going to talk about assignments in a couple moments. CRA is aggressively auditing in this area, and the numbers here speak for themselves. Okay. It's in between April 2015 to March 2020, they've issued almost it's about $825 million in assessments. It's a lot of money, and I can tell you from our contacts at CRA, they're not even close to finished. Not even close. There's a lot of CRA interest in this area. We're going to talk about those new residential and new housing and new residential rental property rebates. Those are getting audited. Almost every single one of them is getting audited. And we'll talk in a minute about certain areas that trigger an audit. Okay. So one area of concern, we talked about the freehold houses and the building of a new construction home. CRA has obtained all the building permit information in Toronto from 2012 to date. And CRA uses MLS and the information real estate agents put on MLS, including staged photos as evidence of a business transaction. CRA has started obtaining further information from third parties, and the courts greatly expanded CRA's ability to do so. The courts have been faced with a few different decisions of late, and the courts don't want to be seen as inhibiting CRA's ability to collect tax and enforce the Income Tax Act and the HST, legislation. There was a recent case of RoofMart, and the federal court ordered RoofMart to disclose all of their customer contact information, the CRA business numbers, itemized transaction details, and bank account information. RoofMart is a major roofing supplies distributor, and CRA basically went on what the law would sometimes call what's called a fishing expedition. And basically they said, look, we think somewhere in some of your customers there's non-compliance for HST on residential construction or in contracting. We want all of your customers' information. And they actually were successful in court. Now, it's very interesting. CRA actually has significantly more information gathering authority and ability than in many circumstances the police. So CRA's ability to obtain information is very broad, and it's been broadened in the past few years. Another example of a case similar to RoofMart is actually PayPal. I think it was in 2017 that PayPal was ordered to hand over all information and all balances and everything to the CRA on all Canadian citizens holding PayPal accounts. That is a massively broad use of their powers, and the federal court granted CRA that application in a few sentences. It was a really startling decision, and it just showed the breadth of CRA's power, and they're starting to exercise it. So CRA, in a lot of cases, we've seen CRA send demand notices and similar requests to individual real estate brokerages, and we're actually expecting those to pick up. I've been told personally by CRA that they expect to be issuing what's called third-party demands on real estate brokerages, which is a concern, and we'll talk a little bit more about that in 1 second, about the relationship between a real estate agent and their client. So a quick example, just to give this to show that there's real practical, real-world consequences here. Now, we talked earlier about, so we have new construction. We all understand that whenever you have new construction, we got to think HST, it's a problem. So when we have a real-world example here, and we'll talk about how to get out of that otherwise portion of the definition. So this is a case called Wall, and Wall was in big trouble. Wall was a Vancouver real estate agent who sold 3 newly built homes and claimed all 3 as his principal residence. None of the houses were owned for more than 21 months. One was owned for 21 months. The other 2 were 16 months. CRA has what's called a real estate appraisal division. And part of the process here and what they're going to look at is they're going to look at how long did someone live in the property after the construction. And we're going to talk about that. But the Wall example is a good one because the court found him totally not credible. The court used much harsher language. Excuse me. The court used much harsher language than I did here. This case is totally public. You could read it. Just Google the 2019 TCC 168 number, or you can go to the tax court website and pull it up. The judge used extremely harsh language for poor Mr. Wall, but he was assessed full income tax and GST payable on all 3 properties. And if I remember correctly, it was over $5 million worth of properties. Now that's in BC, and HST is higher in Toronto, in Ontario. It's at 13%. And they assessed him gross negligence penalties. So those penalties are 50 cents on the dollar for income tax and 25 cents on the dollar for GST. So if someone is assessed $1 for HST, pardon me, if someone is assessed $1 for HST, the penalty will make it $1.25. And then there's interest on top of the $1.25. So if you're assessed 2 or 3 years back, that dollar of HST is actually really going to turn into almost $1.37 to 40 cents. The penalties and interest are substantial. Now, Mr. Wall was a real estate agent who was aware of how taxation works. That was a finding of the court. They said he had knowledge in taxation on real estate. And Mr. Wall's reported income was extremely low. One of the mortgages on a property on the 3rd house was $2.1 million. And someone reporting $18,000 of income, there's no chance on earth they can afford a $2.1 million mortgage. You would need something and factual circumstances so unbelievable to convince a judge that that's possible. So with the Wall example in mind, let's take a look at the legal factors considered when determining if something is subject to HST. So remember we again talked about if something is if we can find an exemption, pardon me, if we can find an exemption out of HST. And I'm going to go back here to a previous slide. So I'm just going to go because I didn't want to repeat the definition in multiple slides. It's just going back here for 1 second. I apologize for this. And I'm using multiple monitors, so it's tough. One more back. Okay. Well, it's 2 more back. Sorry about that. So this definition, okay. And you'll see here it says, but does not include. But does not include an individual described in paragraph A, B, or D. A is really the most relevant one for our purposes. Who carries on the construction or substantial renovation, engages another person to carry on the construction or substantial renovation for the individual, or requires the complex or interest in it. And then I'm going to use my mouse here. otherwise than in the course of a business or an adventure or concern in the nature of trade. This sentence is extremely important. Business is loosely defined in the Excise Tax Act, but an adventure or concern in the nature of trade is not, and it's defined primarily by the case law. And that's basically the history of cases that we have, the jurisprudence that we have over time. Now, let's take this and go back to our example here of wall. So what on earth is an adventure in the nature of trade, you ask? HST is not applicable if the property is not built as a business or in an adventure in the nature of trade. The factors that a court will look at is, we're going to go through them quickly. What is the motive and intention of this person? This is the number one factor CRA is going to look at for sure, and a court is probably as well. If CRA is of the view that you're building a property for financial gain, if that's your intention, is to make money and eventually list it for sale, you're going to be subject to HST. That's a fact. That's CRA's position. They've taken a very hard line on this, and they've become very aggressive in this area. The work complete, if it's a new house, one thing CRA will look at on a new construction house is whether or not the house is what some auditors call a cookie cutter house, essentially like a subdivision house, or if there's unique features of the home that point to that personal intention and personal motivation. For example, did someone paint one of the bedrooms all pink? Normally speaking, if you're Mattamy Homes in Minto and you're selling homes, you're probably not going to paint one of the rooms all pink. You're probably going to use neutral colors all over the place, white and gray. Expertise in real estate. This is one factor that weighed heavily in favor of adventure in nature trade in the Wall case. Wall was a real estate agent, and the courts imputed tax knowledge and imputed an expertise in all things real estate because of his status as a real estate agent, even though part of his testimony was he hadn't actually practiced in real estate for many years. History of similar transactions. So one thing that CRA always, and the courts will always look at, is how many houses have you built? Have you done this before? Obviously, someone who builds 6 houses in 10 years is going to have a much tougher time convincing a court or a CRA auditor that they're not building in the business, not building for business, versus someone who maybe has 2 built houses in 10 years and they lived in both of them. No one for a second is going to believe that you built 7 houses in 10 years and your intention was to move into all of them. It's absurd. It's not going to fly in any court, it's not even going to make it past CRA. The court in Wall, the example and the facts that I gave you before, it noted all of these factors pointed to a business and adventure in the nature trade. He was motivated by money. The houses were complete. They were totally rebuilt. They found he was an expert in real estate. He built 3 houses in a very short amount of time. And the last factor, this is one that previous cases didn't discuss that much, and they term it feasibility. I like to call it affordability. Okay. So affordability is CRA looks at your declared income and they look at all your assets. And the question becomes, could this person actually afford to live in this home? And what happened in Wall was it was obviously ridiculous. Nobody making $18,000 a year can afford a $2.1 million mortgage. Remember, for a personal use home, your mortgage payments are after tax, not before tax, after tax. You have to eat before you pay your mortgage. There's necessity of life. You need to drink water before you pay the mortgage. On $18,000, you wouldn't make it a month on a $2.1 million mortgage. So immediately CRA has affordability and red flags on such a transaction. So we see this as a common theme in a lot of our files. A lot of people, when we're litigating an HST dispute, have multiple mortgages. So if you have a construction mortgage at 7, 8, 9%, and it's a very expensive mortgage in Toronto these days, very, very expensive. On $1 million of construction, that's a lot of money on a monthly basis. When you refinance after the construction, you or your client are going to have to show CRA that you could afford it after the refinancing. CRA is not going to believe that you intended to carry $1 million mortgage at 9% for a prolonged period of time. It's not believable, and frankly, it's not true. Hardly anybody in Toronto can afford that. So one thing we want to move now just to quickly are assignments. I know I anticipate I'm going to get questions about assignments. Assignments, loosely, when I use the term assignments, I'm referring to mostly pre-construction condos. Okay, so it was especially commonplace in the real condo boom 2012 to call it even earlier than that, 2011, let's say, to 2017. It still happens frequently. It's when you sign an agreement of purchase sale with the builder, and then you sell that agreement of purchase sale to a third party who then closes on the deal, pays the builder out, and moves on. CRA will use the same factors outlined that I just talked about to analyze and determine whether or not the sale of an assignment is an adventure in the nature trade and subject to HST. And we want to comment here because, just stop here. I know this seminar is focused on HST, but HST on assignments is a major issue and determination when it also comes to income tax. So an assignment that's subject to HST will also be 100% fully taxable. It will not be subject to capital gain rates. And a capital gain is when only half of the gain is taxable. In a situation where CRA alleges you're doing this as a business in an adventure in the nature of trade, the whole gain will be fully taxable. So if you make $100 and on $100 for a capital gain, at the worst you're going to pay is $25 or $26, assuming that you're in the very top tax bracket, making $500,000 a year. You're going to pay 26% roughly. For a business transaction, your taxes in the top tax rate will effectively double to $50. Plus, you're going to have to pay another $13 of HST. So the difference between a business transaction and a capital gain for tax purposes is not just the $13 of HST. It's effectively your income tax exposure would double. So when CRA alleges a business transaction instead of a capital gain, in the $100 example I just gave you, your increase in taxation, it would go from 25 up to 63. It's a huge jump, huge. So on a $100,000 gain of an assignment, we're talking about a lot of money, or even more. I've seen even larger gains on assignments. So when we have assignments, we have to be very careful. Assignments in the normal course cannot be sold totally tax-free of either income tax or HST. This Income Tax Act, which is quite thick and always on my desk, basically says in a short term, in order for you to claim the principal residence exemption and not be subject to HST or income tax, you need to what's called ordinarily inhabit the property, the residential property, in the year. A lot of assignments are sold prior to the completion of the condominium. You are not living in a hole at Yonge and Cummer, for example. I haven't been there in a while, but I know there's a condo going up at Yonge and Cummer that presumably, assuming it's not ready for inhabitation, you can't live there. So if you sell the assignment, it's taxable one way or another. The real question is that, can we get you out of the business taxation and get you out of HST, which means we're pushing you down to capital gains rates. So CRA on an assignment will look at a myriad of factors, But on and we've had actually a lot better success over the years. When this project at CRA started, we're looking for HST on assignments. They really thought that people were buying and selling assignments en masse. They thought this was a giant business, etc. Over time, CRA admittedly has softened their position a little bit. They understand that between the agreement of purchase and sale and the eventual closing of a condo, it could take 5 years, 6 years, even 4 years is a long time. Time does not stand still, and people's circumstances change. We had a situation years and years ago where our clients bought a 1-bedroom condo, and surprise, they had twins. Anybody with 2 kids here would agree that a 1-bedroom condo is not likely to be suitable for twins, and they had to sell it on assignment. Obviously, a material change in circumstances in the intervening period. They were given capital treatment. That was the correct answer. And they didn't live in the condo, so they couldn't claim a principal residence exemption. But the point is, the HST was not applicable because we were able to show that it wasn't purchased with the intent of a business transaction. Our clients had no expertise in real estate. The 1-bedroom condo would have been plenty affordable, and they had no history of the transactions, similar transactions. The more assignments you have, the more problematic it's going to be from an HST perspective. Okay, so just moving on. So we're going to talk a little bit more about the HST rebates, but that's a good idea for a good overview of the taxation of assignments. There is an HST problem if CRA views the sale of the assignment as a business transaction, because at the end of the day, you're essentially selling a contract. You're not selling a completed home in most cases. There could be some very interesting issues. We've seen assignments in the past where the assignment was sold because the person couldn't close, but they had been living in the property paying the occupancy fees. This is on a case-by-case basis. There's some very unique cases that we've seen in the past on assignments, and it continues to be a major issue. But before the sale of assignment, no doubt about it, in the vast majority of cases, it is taxable, and your clients should get tax advice to understand their exposure on the sale of the assignment, because what they're really concerned about is what is their net profit after tax. Okay, so back to the new construction homes. This is an extremely complex area, and it's called self-supply. So self-supply is basically when you build a home, CRA can allege that you are a builder, even though you're living in the home, because we believe you intend to sell it. You're just basically staying in the house as a hotel. So there's one exception to personal use here, and it's very interesting. And we're going to go through it bullet by bullet briefly. But these rules are extremely complex. They kick in when someone moves into the house. And if that person is moving into the house, CRA could argue that you're taxable and you must pay HST on the fair market value. If a tenant moves in, the self-supply rules will kick in. We're just going to set that issue aside. The only way if CRA sees a new construction home where someone moves in, there's only 2 ways out of it. One is if CRA determines that you're not a builder at all. It's one possibility. The second possibility, if CRA views you as a builder, this exemption can get you out. So just the 4 bullets. I'm going to go kind of in reverse order, A, D, B, C. Okay. A, the builder is an individual. This is not complicated. If you use a corporation to build a new house, you are subject to HST. There's no doubt about it. There's no getting out of it. If you build a new house with in the name of a corporation, you will be subject to HST. So, A, the builder is an individual. D, the individual has not claimed an input tax credit. That means you haven't claimed any of the expenses on the construction of the property, of the home, pardon me. And then B and C are always the most difficult. A and D are usually obvious in our cases. Excuse me. At any time after the construction or renovation of the complex, or addition is substantially completed. Complex is used primarily as a place of residence for the individual related to the individual, or a former spouse or common law partner of the individual. So this is pretty complex when you piece it out. What does the term used primarily as a place of residence mean? And then C is a very bizarrely worded section here. The complex is not used primarily for any other purpose between the time of the construction or renovation is substantially completed and that time. That's a little odd. It's kind of the opposite of B. Again, these definitions are a little bit of a head scratcher, but used primarily as a place of residence is the important part here. CRA, in some cases, is alleging that people are moving into the home simply as a temporary time, and they're effectively living in it as a hotel and not a place of residence. Sometimes this assertion is absurd, it's ridiculous, but that is CRA's position, is that yes, you may have moved in, but we don't think you're moving in to actually live there as a place of residence. You're moving in, and to read between the lines, to pass this off as a personal use home. CRA has gotten very aggressive on this argument, and it's going to be a problem once it starts getting litigated en masse. CRA will use all the factors that we talked about before in determining whether or not you use the property primarily as a place of residence. Paragraph C really looks into if you rented it out between at some point. It's bizarrely worded because it's kind of like the opposite of B. But what they're really looking for is, what was your intention at the time you moved in? Were you simply staying there as a hotel, a temporary place to sleep, or is it a place of residence? Residence meaning real intention to stay for the long term. So a question I always get in these kind of seminars: how long does one have to live in the house? Nobody knows. That's the truth. Anybody who tells you 6 months, a year, 2 years, there's nothing in this legislation. You will not find in this book or in this piece of legislation, this is the HST Act, it's pretty thick, you're not going to find a number of months you have to stay in the house in order for it not to be subject to HST. There's no doubt about it from a litigation perspective. As someone who litigates with CRA for a living, the longer you live in the house, the better. CRA is using the building permits to audit these new construction houses, and they're looking for HST. They will take the building permit, they will take the occupancy permit, and then they'll look at the MLS listing. And they look between the occupancy permit and the MLS listing, how much time passed. The more time between those two dates, the better. The more likely CRA is going to believe you intended to live in that home. Those are the critical dates. Another thing that I would note is CRA, we talked about the tools at their disposal with audit activity. One thing that is at their disposal that is oftentimes not friendly to people is Google Street View. Google Street View goes back in time, and CRA uses that to guess when they think you moved into the property. And, I'm sorry to pick on poor Mr. Wall, but he's in Vancouver, and I assume a lot of our agents are in the GTA. But poor Mr. Wall bought and then sold a house in 16 months. CRA, through their real estate appraisal department, they've got a pretty good idea of A, how much construction costs. That can be determined through engineers and cost consultants. And B, they know how long it'll take to build that house. They have a pretty good idea. A house, at the fastest of times we've seen, the best we can see is 10 months it's inhabitable, 9 months it's inhabitable. But when you buy, list, and sell in 16 months, you could not have possibly lived in that house for longer than 6 months. There's no way. it's impossible. And CRA doesn't really care how long you lived in the house prior to construction. They want to see you living in the house after construction for all these issues that we just talked about. From a legal perspective, I'm not a big fan of this interpretation by CRA. I think it is relevant how long you've owned the property as a whole. So if you own a property for 10 years, renting it out, even living in it, and then you rebuild it, and then you live there for 8-9 months and you sell, the fact that CRA doesn't really factor in the 8 or 9, let's say even 10 years prior to construction that you had this property doesn't really jive with the law. I think that's a bit of an aggressive stance, but that's how CRA is interpreting this at the time. We don't have great case law in this area. We don't have great direction from the courts on how to deal with that. But I think it's a very aggressive position. And right now, I'm just reiterating again, CRA's position is they want to see how long you lived in that house after construction. And they really will not care much about the prior period. Okay. So this is one very unique situation that arose in a building in downtown Toronto, and it's a matter of public record. The tax court's totally public. I know there's a bunch of these issues in tax court currently. Leaseback agreements with the builder of a condominium are fraught with potential issues. So this is a condominium downtown Toronto where the builder, as part of their advertising to entice buyers, they would say, okay, if you buy this property and you sign this lease agreement with us, we will guarantee X dollars of rent for a period of, let's say, 2 years. So it's an incentive to buy. Not everybody's cut out to be a landlord. Not everybody wants to deal with tenants. It can be a nightmare in the worst of times. And so what they've done is they say, okay, fine. The purchase is fine. And they sign an agreement of purchase and sale with the builder. And they also sign a leaseback agreement with the sister company of the builder. And in those agreements, it guarantees a fixed rent. And if the sister company is able to get above, I'm just making up a number, $1,500 a month. If, let's say, they get $1,800, they keep $300 on their own. So this is a very interesting situation, and you have got to be very, very, very careful before signing one of these agreements. This triggered a self-supply and a denial of the new housing rebate on every single one of these units. So what happened was that CRA took the position that said, you're leasing these out for commercial rent. This is a commercial agreement, and all of you meet the definition of a builder under Section 123, and they had to pay the fair market value, HST on the fair market value at the time of closing. So let's say you bought it for $100,000. You got to pay the builder HST. You paid $100,000 plus HST in 2015. Obviously a ridiculous price, but let's use the math. So you paid $113,000 in HST and a final sale price to the builder. And then come 2020 rolls around and it's worth $200,000. CRA asked these people to send them another $26,000 based on the fair market value in the time it closes, saying you are subject to a self-supply. You're a builder because you leased it to a company and not out to an individual. This is an aggressive approach on CRA's part, but certainly not totally without merit. These type of leasebacks have become more common as incentive to buy condominiums. I think we're going to see more of them. I'm told just from real estate agent clients of ours that it is becoming more commonplace, but this is a very dangerous arrangement from an HST perspective. So CRA is arguing that all these people are subject to the self-assessment, and none of those exemptions, it's not for personal use. You're leasing it to a company who's lending it out to Joe Smith, who knows? So it's a major problem from a CRA perspective. Problem with HST new housing rebates, and you saw on the audit statistics, is here. You'll see, look at that, 500 million audit assessments here, 36,800 files completed, and that's not even how many are still being audited. And this is March 2020. These numbers have increased. That's $500 million in reassessed new housing and residential rental rebates. Huge, huge problem with CRA. And the real problem is an evidentiary problem. When the agreement of purchase and sale is signed, it could be 5 years before the condo is finished. And the section you'll note here says at the time of signing the agreement of purchase and sale. So they're talking about, let's say you buy it in 2015. They're talking about what was your intention in 2015. The landlord rebate doesn't care about intention at the time of signing the agreement of purchase and sale. This, what was your intention at that time? Proving, nobody takes a video of themselves signing the agreement. They take a video on their phone. Do they say, oh, hi, my name is Adam. Today is April 22nd. I'm signing this agreement of purchase sale. I intend to use this as my principal residence. It doesn't work like that. It's obviously absurd. Nobody does that. But CRA is going to look at all the factors surrounding what your actions were around that time. If you sign 6 condo purchases on the same day, they're not going to believe that you intended to live in all 6. If you sign a condo agreement of purchase sale for a condo, and let's say you wait 4 years and do nothing, you don't do anything, you still live in, with your parents. That's a lot easier of a case to prove that your intention at the time of purchasing that property was to live in it. So these are always evidentiary. There's hundreds of cases in the tax court on these new housing rebates. They're a major issue, and the volume of CRA audits are really, really amazing. And this is huge money in this for CRA because, there's for example, on the northeast corner of Yonge and Eglinton, those condos are huge. Every single property in there got $24,000 for the government. So there's a lot of money on the line for them. So in the end, this is a real crash course in HST on new construction. Whenever a client is selling a substantially renovated or brand new home, assuming most of the people here are real estate agents, HST will be a factor that has to be considered. You got to do the math. And HST and OREA agreements, purchase and sale, are normally, quote, included in. HST is a significant liability, and if assessed later, will come with substantial interest and penalties. Your clients may not know the risks involved in the potential liability. You need to get them the advice they need. Many new construction houses lose money after HST is factored in. Because the amount is included in the sale price, it's a lot of money. The HST is, if your profit on a house is 10% after all your real costs, you're going to lose big money on HST. There's a lot of costs in there. For example, you don't pay HST on the interest on your mortgage, and always a factor in our cases is proving the amounts of HST paid to trades. If your house is subject to HST, proving the costs on the house is always a big fight with CRA. And the last thing I want to leave you with is, I mentioned earlier that there's a lot more CRA activity with brokerages. They're getting information from brokerages. They want to see your agreements with your clients to see what the intentions, if they can get any information there. And just be aware, there's no solicitor-client privilege between a real estate agent and their client. CRA could put real estate agents in a very uncomfortable situation about asking them questions directly. We've already seen them ask for information, but they have the power to ask all sorts of questions of real estate agents. We've already seen them do this with architects. That's a major problem, because what they're getting at is, what was the intention of the person who built the house? And always be careful about that. That is my 45-minute extremely rushed crash course here in HST. I think the bottom line is get the advice, do the math. HST is a major factor on assignments and on new construction houses. And this is not a hypothetical. CRA is actively engaged in audit activity in this industry. So I will ask Vita to come. Oh, there she is. Hi, Vita. And we're happy to take any questions. I believe I'll leave it to Vida. Sorry, Vida.
I'm gonna try my best. There are some questions. I have a few on the side. If you don't mind, I'm gonna start with those. Not quite sure if you answered them during your presentation. So first question is, how long do I have to live in the property in order to avoid HST on the scale of the property?
So,
property, sorry.
Yeah, we mentioned this very briefly. As a litigator, the longer you live in the property, the better. 6 months is not a long time at all. It's not going to do the trick. CRA will always look at the frequency of transactions. The longer, the better. If we're talking someone lives in a property 3, 4, 5 years, that's what CRA is going to view as an extended period of time. That's the range you really want to be in to sort of dissuade CRA from thinking that you're engaged in a business. Obviously, if you do this 10 times every 2 years, it's a problem.
Okay. Second question, if a client gets a new housing personal rebate, can they switch to the rental rebate?
Correct. Yes, they can. So oftentimes builders are automatically applying for the personal use rebate. The truth is, if someone changes their mind, let's say, Vida, someone changes their mind at the last possible second, they decide to rent out the property instead of living in the property, it's simply an application. They're highly encouraged to do it because there is a 2-year time limitation. That there are ways to get around that, but it's very complex. You don't even want to go down that road. If you know you got a personal use rebate on the closing and you are in fact renting it out, which means you do not qualify for the personal use rebate, change the rebates and just get it done. You're going to pay a couple $100 in interest at most, and it's well worth saving the headache later on of a CRA audit.
Okay. If my client gets assessed for HST on the sale of the property, can they claim any HST that was paid?
Yes, they can. So CRA, this is going to be a bit more of a complex answer. If your client has an HST number, personal HST number already, then it's a lot more complex because they fall into what's called the input tax credit rules. There's specific criteria for invoices. If they don't have an HST number, then the rules are a little more flexible because they qualify for what's called an HST rebate. And on the rebate, there's not really as many outlined criteria in the legislation for what needs to be on an invoice. Yes, they can claim anything they paid HST on.
Okay. My client has built many houses and is scared of an audit. Is there a way for him to make a disclosure to CRA in order to avoid penalties and interest?
Yes. So currently there is what's called the voluntary disclosure program. It is still up and running. It is a way to sort of wipe the slate clean, confess your tax sins, for lack of a better term, and try and avoid some interest and penalties. It guarantees a lot of penalties won't be applicable if it is accepted. There are criteria that we go through with our clients to see if they qualify. We have a very, very good track record of voluntary disclosures. It's highly recommended because always, Vida, if CRA finds you, they're suspicious, right? If you go to CRA with a problem and say, hey, I messed this up, I want to come clean, there's what's called the air of credibility. CRA is going to believe you a lot more if they don't have to come find you. It's common sense, right? If CRA audits you and it doesn't look good, they're not going to be happy and they're going to be less inclined to necessarily believe you. The voluntary disclosure program was amended greatly in March 2017. It was made much more difficult and regimented, but it still exists. It's still a good program, and as an offhand advice, I don't believe it's going to exist for too much longer. that door could close and it won't open again.
Okay. I'm going to go to one of our first question on the chat box. Mr. Hamid, I believe you answered it, but I'm just going to read it again. Mr. Hamid Reza Khursanchian says, is the listing brokerage or realtor responsible or in trouble when the client gets audited for HST after sale of brand new home?
So we always tell our realtors and brokerages, do not be handing out tax advice whatsoever, right? The best way to make sure you're not going to be held responsible or liable is you tell them, hey, I don't know about this area, go get tax advice. And you can send that quickly in an email to them. That's your get out of jail free card kind of thing on that. It would be extremely difficult, if not impossible, for a listing brokerage or a realtor to be responsible or get in trouble for HST. However, these aren't, a lot of you are in the repeat customer business, right? One phone call could save your client a ton of money and in HST, and it can't hurt you, to advise them to make that phone call. An issue also is that it's getting a little uncomfortable because, again, you don't have solicitor client privilege. When I have meetings in my office with my clients, that's confidential conversation. Nobody's ever going to find out about that. What realtors write on, if a client finds out that a realtor used a description on the MLS listing, and CRA is going to point to that as if it's the Bible. They're going to believe whatever you write in that HST listing. So I know all of you write custom home, beautiful house, all those catchphrases. They're nice and they're in a lot of listings. That may not be in your client's best interest. And if CRA is utilizing that, literally I've seen them presented as evidence in court, that's not a great day in terms of your client's view of you and relationship. It's not a good thing.
Mm-hmm. Mr. Mehdi Saragian asking, if buyer sells a pre-construction property by assignment without any profit, even with losing money based sale price, does client have to pay HST?
Yeah. The answer, actually, Mehdi, and I'm waiting to get a file where someone's lost big money on assignment. There's a possibility your client could get an HST refund. So the answer is, if you tell CRA, yes, it's subject to HST, but I lost money on this assignment, you're not in a profit position. You're in a refund position. I was at a CRA, a small CRA HST seminar. Actually, Betty, I asked the same question as you just asked. And a few of the people started laughing, but the CRA official who I talked to, he wasn't laughing because he realized this is a big problem. CRA has been assessing HST on the sale of assignments because there's always, if you bought a condo in 2012 in Toronto and you sold it in 2016, the chances of you losing money are really low. Just Vita's nodding her head and she agrees with me, but it's a really low chance that you lost money. The question is, CRA can't really have their cake and eat it too. What happens on the flip side of the situation? Did we cut out? Sorry, I think we cut out there for a second.
Yeah, I think.
Okay. I think because we're a minute over time, but no, Betty, that's a great question. In my view, I think CRA may have to pay a refund for HST. That may actually be a situation where you're going to want to tell CRA about this. When it comes to CRA, you want to brag sometimes about how much money you've lost to get a loss.
Okay. Mrs. Sarah Kalali asking, based on your explanation, is that a good reason for CRA to say I can't afford the mortgage and property tax of this new home after home build and repeat this every year as individual, not builder?
No, this is not a good strategy because CRA can deem you to be a builder. Affordability is CRA's biggest issue. CRA CRA's position, generally speaking, is you know how much the building is going to cost, and you shouldn't be building a house that's a $2 or $3, $4 million house by just guessing how much it's going to be cost you when you finish it. So affordability, especially if you repeat it, it's CRA expects people to learn from experience. If it's a repeated issue, it's a problem, and you can't use affordability as a reason for every single sale of a new construction house. The CRA, especially if it's repeated each year, it's going to be a problem, and CRA almost certainly will assess HST on those houses.
Okay. Our next question, Mr. PJ Tallet, is it true that having private financing amplifies your chances of getting hit with HST?
Yes, it's true. It's true. And the reason why is that private financing is a red flag for CRA on the affordability front. Always they look at how much is that private financing costs you. I understand from a business perspective, it's very hard to get a construction mortgage, generally speaking, from the major banks. You got to usually go private for construction mortgaging, and CRA is okay with that. They understand that. But the question becomes what is your mortgage rate after you refinance when the property's finished? Is that something you can afford? And if you have a 6 to 7% private mortgage on the property after it's finished for $1.5 million, that's an issue. I mean, they're going to take that as a red flag. Why couldn't you afford to go to an A bank after it was financed?
Mr. Ray Neely is asking, how about HST for Airbnb?
Yeah, HST on Airbnb, it is subject to HST. This is a big issue. Airbnb was, I mentioned, sorry, I didn't finish with Chima, but I mentioned that there was some positive HST rebate comments in the budget. There was some negative comments about HST for Airbnb in the budget. They emphasized that they're going to go after Airbnb. Remember, CRA is always delayed. Everybody at CRA works at most 9 to 5, most. Everybody here in the private sector, we work all day, all night. I mean, I turned off my laptop at 10 last night. So we're ahead of CRA in many respects. And CRA, as I jokingly tell my clients, CRA didn't find out Airbnb existed until like last year. They didn't really get around to that. It's subject to HST. Short-term rentals are subject to HST. They're no different than a hotel, and they could be viewed as commercial property on the sale, which is a little dangerous as well. But there is a comment in the budget that CRA is gonna start assessing HST more aggressively on short-term accommodations.
All right. Mr. Shaheen is asking a question regarding the capital gains tax on a property that was used as principal residence for a duration that the owner owned the property. Is the capital gain tax calculated from the time the use of the property has been changed from personal residence to rental, or they will average the price increase and pay the proportional part?
Yeah, so that's not an HST issue, but I can still answer it. There's an election called 45-2 election in the Income Tax Act. You got to make the election. You can the answer. The truth is that if you do the election or not the election, you could do either of these situations. If you don't make the election, CRA will usually average out the price. If you make the election, you can declare what's called a deemed disposition on your return. So basically, let's say you buy it in 2015 for $1 million, and today in 2021 it's worth $2 million. You can declare a deemed disposition on your tax return, and then moving forward, any gain beyond $2 million will be subject to capital gains tax. But you just got to be aware of it. You got to inform your accountant that you're moving in or out of the property. You got to make that choice at the time. If it's 6-7 years after you've already started renting it out, it's too late. You're going to average it out on the life of the property. The choice is gone.
All right, Mr. Ramin Riahi, he says, my client have a company and bought a 30-year-old condo and renovated and sold it. Should he get HST from the buyer? He bought that condo under the company name.
Yeah, it's the condo. You have to determine if it's been substantially renovated. Condos are a little tricky. It's very hard to get into a substantially renovated condo. I can't say yes or no without, I would suggest you get some advice to determine whether or not that condo was substantially renovated. I think from a business decision, what he should do is determine what his HST exposure is, perhaps. And then he could have a conversation with a firm like ours to determine whether or not it's potentially subject to HST. Again, condominiums, renovating a substantially renovated condominium is very difficult. I had one CRA officer who told me bluntly she thinks it's impossible because you can't get into the walls, right? I mean, you can't go down to the studs in a condominium. There's limited. We talked about the exclusion, the interior walls, the exclusion of the floors. Like, what else are you doing in a condo in terms of a renovation? So it's very difficult from an HST perspective.
Okay, I have another question on the side from Mr. Yahya Dardishti. He's asking, my client has a home that has been a rental property for several years. He's now thinking of either a full renovation, 50% plus, or a tear down and rebuild. He's curious what the HST implications will be if he decides to sell the property after the construction is complete. What if he lives in it for a year or so and then sells it?
Yeah, so the year or so living is, I'm going to start from the end of your question and work backwards, if you don't mind. The year or so may not be good enough. There's a million other factors that we got to look at in terms of his whole life. In terms of construction, whenever you demolish a house, you're getting into HST waters. If you demolish a house and rebuild it, you got an HST concern. If you're renovating just 50% of the house and you're just sort of cleaning it up to move on to after the tenant is, because it's like uninhabitable. I've seen tenants destroy houses and it just needs a little bit of work, 50% of the work to just sell it. That's fine. You're very unlikely to be subject to HST.
All right. Mrs. Azadeh Payande, if an owner lose money on buying a property, live there and sell it, the money they pay for mortgage and all the expenses is more than the selling price. How can they claim the loss?
Yeah, you can't claim a loss on personal use property. So if you have a principal residence that you lost money on, it's very difficult to claim a loss. You're not really supposed to. If it's a rental property, you can claim a loss, really capital loss on the land portion of it, which is usually most of it. So the answer normally in a principal residence situation, no, you're not really supposed to claim a loss. But if CRA assesses HST on a property, I should have mentioned this earlier. For some of our properties that CRA's tried to claim HST, we've actually been claiming income tax losses. So CRA can't have their cake and eat it too in a lot of cases. From an HST perspective, there's always a payable to CRA, but that doesn't mean necessarily you won't get a refund from CRA. But to answer your question, is that if you have a personal use property like a principal residence and you happen to lose some money on it, you're not really supposed to be claiming a loss on that.
Okay, Mr. Adam, there is a few more questions, but we are well after the 1 hour presentation. I would like to thank you on behalf of myself and PICRA associations and our viewers and all our volunteers that are working so hard to keep these webinars and PICRA going with the services. We appreciate you for your wonderful presentation. I like to ask all our colleagues and the viewers to please reach out to Mr. Adam. His contact information is going to be attached down below to this webinar. And all the questions with our friends, I would ask them to call you and ask you. I'd like to invite everybody to our next webinar that is going to be on May 28th at 1 p.m. We are going to have another lawyer, Mrs. Peria Rod. And thank you so much, everyone, for joining us. Mr. Adam, again, thank you so much for coming.
Not a problem. Pleasure to be with you. Take care.
Thank you. Have a great day, everyone.